I would have expected, if you would have told me the regime change that the Fed put forth, the war in Ukraine, a high price, flying through with inflation at 8.5%, that we would have seen a lot more carnage in the equity markets and even more so in the fixed income markets, despite some of the sell-offs that they've witnessed year to date. What continues to give me good confidence heading into the end of the year, let's say, is that we still have very strong nominal GDP. I think we're just in a higher nominal GDP growth world, and it's something we're going to have to get used to for a number of reasons. One, taking into account the backlog that we have for orders, autos, housing. That's not going to be curtailed by 5% mortgage rates. We also have a fact that there's 11.3 million jobs that are unfilled out there right now. Unemployment rate is still very low. The Fed is just starting their tightening cycle. I think they're way behind the curve. Lastly, you have tons of stimulus, that hasn't completely rolled off yet. There's just more signs that I think economic growth is going to be a stronger engine than people expect. And we're not even taking into the account that COVID is just moving from pandemic to endemic. I think people are eager to move forward and really start to jumpstart the economy. I think the Fed, with the move that they had earlier this year, they missed an opportunity to do a lot more to get ahead of the inflation spike and to show that they were serious. And I don't mean to, be a Monday morning quarterback and second guess, people running central banks around the world, but there's a clear desire to maintain economic growth ahead of inflation. And I think what's happened is that traders now have gone from projecting inflationary trades, which tends to be a shift from early cycle to late cycle trades, for most equities to do well in those environments because the Fed tends to raise before we've seen inflation increase and rates increase.